There has never been a greater time than now to invest in the Metro Detroit area, and there is no other investment firm better qualified than Platinum Real Estate Holdings. With 40 years experience and over 1,000 homes sold, let Platinum Real Estate Holdings assist you with the purchase of a city-certified home of the highest quality, turnkey properties, screen renters, yielding instant cash flow. Well, what are you waiting for? Call or visit us online today.
Welcome to the weekly recap for the week of May 8th. In today's recap, we're going to talk about why a 30-year mortgage can give you a better shot at wealth building than a 15-year mortgage. And lastly, we're going to share 5 types of insurance you may need if you run a real estate business. This week's recap begins now. Have you ever asked yourself the question, should I go with a 30-year mortgage and have a lower payment? Or should I go with a 15-year mortgage and pay off the loan faster? Scott Trench, a writer with BiggerPockets.com, says a 30-year mortgage could give you a better shot at building wealth. Scott says the true answer is, it depends. It depends on your goals and objectives. However, when considering when a 30-year mortgage is better than a 15-year, these key 5 assumptions were forwarded by Scott. Number 1, we're assuming that the property prices and rates will increase with inflation at about 3.4% per year. Number 2, the interest rates are at about 3.5%. Number 3, the expenses related to maintaining the property will be at about 50% of the rent the property would collect. Assumption number 4 is that rents are at about 1/10 the value of the property. And lastly, number 5, we're assuming that the stock market produces an 11.5% annual return rate. The majority of this article points towards real estate investors. However, Scott says this could work for homeowners as well. For the purposes of this argument, Scott would like us to reframe the question. Let's ask instead, if my goal is to give myself the greatest statistical probability of building more wealth over time, should I go with a 30-year mortgage and have a lower payment? Or should I go with a 15-year mortgage and pay off my loan faster? If we ask the question exactly like this, Scott says the short answer to that question is yes. A 30-year mortgage, according to Scott, is better than a 15-year mortgage. And he has the graphs and charts to prove it at BiggerPockets.com. The bottom line for this is the assumption that all excess cash flow is reinvested. An investor with a 15-year loan will produce less cash flow than either a cash investor or the investor with a 30-year note for the first 15 years, and therefore will not be able to reinvest the cash flow. It is the reinvestment of cash flow that separates the 30-year note investor from the 15-year note investor. The investor with a loan term of 30 years will have lower payments, will generate more cash flow up front, and will be able to reinvest those cash flows sooner than the investor with a 15-year mortgage. This is why Scott says the investor with a 30-year note has more net worth and more cash flow. The reinvested cash steadily compounds to build a portfolio that appreciates with the stock market and spits out regular dividends. Over time, the effects of more leverage and greater cash flow compound to the extraordinary advantage of the investor with a 30-year loan. Now, does Scott's analysis necessarily mean that a 30-year loan is right for you? As mentioned at the beginning, the answer to that question is, it depends. There are many reasons why a 15-year loan might be better for you. Maybe you prefer to be debt-free as soon as possible. Maybe you don't think you have the discipline to reinvest the cash flows as soon as you receive them. In that case, a 15-year loan would be appropriate for you, according to Scott. But if your goal is to choose the financing that will help you create the most wealth possible over time, then a 30-year loan is likely to be your best bet. Scott says it's important to revisit your goals every few years. You might find that it's time to refinance and buy more property, or that you will be content to coast on the cash flows you've created already. Next up, 5 types of insurance you may need if you run a real estate business. If you're a real estate professional, you may sometimes feel like you're in the paperwork business. Nevertheless, you're probably still missing key insurance coverage areas. Here are 5 types of insurance you may need if you run a real estate business. Number 1, general liability. General liability insurance is one of the most valuable policies you can have as a real estate professional because it covers costs associated with any lawsuits that derive from your business. And if you're in the game long enough, you're sure to face at least one or two. Number 2, standard property insurance. Whether you're a house flipper or a landlord, property insurance is the bread and butter of your professional life. In general, how much you pay for property insurance depends on the types of structure, structural stability, and protections, and how many additional protections the policy includes, such as flood or fire insurance. Rates tend to vary widely by company. Number 3, health insurance. As a real estate professional, you don't have an employer offering you health coverage, but you're still legally required to have a policy. Remember, you can't do your job if you're unwell, and you don't want to drive yourself into medical debt by ignoring the need for health insurance. Get a policy no matter how great you feel. You can't predict accidents and illness. Number 4, flood and fire insurance. Flood and fires can happen anywhere, but your location is a major determinant on how important such policies are and how much they'll cost. Technically, you only need flood insurance if you're in an official flood zone. Regions that are especially prone to drought and fires, such as parts of California, are likely to present high insurance premiums, but that insurance is also much more greatly needed. And lastly, insurance coverage number 5, data coverage. Data compromise insurance may be one of the most important coverages you could have in this day and age. Simply put, it covers you if hackers steal client information or another data breach happens. Investing in all the right insurance policies isn't about building a wall against the worst case scenarios, but rather about taking care of yourself and your clients. By doing your research, you can put together a portfolio of policies that raise your business up and make it easier for you to operate with confidence in your day-to-day interactions. Which of these insurance types do you hold? What do you think is most important? We'd like to hear from you. Well, that's this week's recap. Did you find this recap helpful? Let us know in the comments below. Thank you for listening and have a great day.
This has been your weekly real estate investment news recap. Did you find this recap helpful? Please like or comment below this video to enter to win a free copy of our ebook, The Ultimate Real Estate Guide for Residential Real Estate Investments. You can also subscribe to our channel or go to our website to receive the latest in real estate news. Our website also affords you the opportunity to view our latest turnkey properties.